For decades, global trade operated on the assumption that cargo could move smoothly across open oceans without interruption. That assumption is failing. Key transit points like the Suez Canal and the Strait of Hormuz are being physically blocked or restricted, forcing the primary arteries of the global economy to a standstill. When these narrow corridors close, ships are forced to reroute around the Cape of Good Hope. This adds 14 days to the journey and has pushed maritime insurance premiums up by 300%. On the mainland, the impact is immediate. European manufacturing centers are struggling to maintain production as the energy and components they rely on face mounting delays and rising costs. The combination of closed canals, restricted air corridors, and record-high insurance suggests that the friction in physical shipping is becoming a persistent feature of the trade landscape. This physical breakdown is putting direct pressure on the financial system. The petrodollar recycling rate has dropped by nearly 19% as nations settle trades in local currencies, while the U.S. Treasury yield curve remains in a deep, persistent inversion. Wealth is looking for an exit. Fearing asset seizures and the slow settlement of traditional banks, global capital is moving away from centralized exchanges that are subject to local political control. This chart tracks the ratio of volume on centralized exchanges versus decentralized ones. It shows a sharp decline to a record low of 3.05, marking a significant migration of capital into non-custodial on-chain protocols. In an environment where physical assets and traditional bank accounts can be frozen by geopolitical shifts, decentralized structures are being used as a primary tool for capital preservation. Scaling the next generation of artificial intelligence requires a resource more basic than software, a massive and constant supply of electricity. This industrial site illustrates the scale of that requirement. By building dozens of these nuclear reactors, China is securing the base load atomic power needed to run massive AI compute clusters around the clock. This chart shows the disparity in energy infrastructure. While China has up to 39 nuclear reactors currently under construction, the United States has 0, leaving its power grid increasingly reliant on less consistent energy sources. To compensate for this energy gap, the U.S. is attempting to maintain its technological lead through export controls on high-end silicon and AI hardware. But because industrial capacity is tied to energy availability, the country that builds the most robust power infrastructure will likely dictate the pace of AI development. As hardware export controls tighten, decentralized networks are emerging as a way to access compute power outside of traditional geographic borders. Protocols like DePIN use a global network of nodes to bypass these restrictions. This allows developers to rent latent GPU power from anywhere in the world, bridging the gap between energy-rich regions and compute-hungry models. This borderless compute is fueling a surge in activity on high-speed blockchains like Solana, providing the infrastructure for an economy run by autonomous software. The data shows that this isn't just retail trading. Autonomous AI agents now account for nearly 48% of the transaction volume on these networks, optimizing liquidity and arbitrage without human input. Institutional capital is following this liquidity. Derivative platforms are seeing record-high open interest, with billions of dollars moving into on-chain positions. These decentralized systems are providing a functional alternative to traditional clearinghouses, offering settlement speeds and transparency that are shielded from geopolitical interference. We are observing a multi-trillion-dollar shift in the global economy as capital migrates from depreciating government debt into cryptographically secured assets. This relationship illustrates a basic rule of digital physics. Information output is tethered to the quantity of energy input. In a world of digital scarcity, the value of an asset is increasingly tied to the energy required to secure it. Financial institutions are now moving to tokenize real-world assets like commodities and treasuries, seeking the safety of on-chain settlement to avoid the systemic risks present in legacy banking. The convergence of decentralized compute, AI agents, and crypto networks is creating a parallel financial system that operates independently of traditional borders. Looking toward 2028, market projections suggest that the continued friction in physical trade and the depreciation of fiat debt could push Bitcoin and other secured assets toward much higher valuations as they become the new global standard for settlement. The transition from fragile physical supply routes to energy-backed, on-chain networks is reconfiguring the global financial architecture in real time.